Hello everybody, welcome to another weekly market news video. Today is Monday, 8th of March, and we are beginning the new week with quite negative note, as last week was again very negative. We were experiencing some sell-offs on especially technical stocks in the United States, as they are, as we know, overvalued from the year 2020, pushed up by unprecedented monetary and fiscal stimulus and all the actions that led to the super higher prices on stocks. So let's look at the markets, what is happening right now and what is happening especially at the beginning of this week. As you can see on daily chart, Nasdaq was able on Friday to bounce from the losses, retreat some of them, and even close a little bit higher. But you can see Monday, the red candle here is again very negative for stocks, as Senate passed $2 trillion coronavirus relief bill, which will most probably will be approved by the House on Friday. So we will see how this thing will play out, and if really this will go through, as this relief bill and this fiscal stimulus should again provide some direct deposit checks to Americans, some unemployment benefits. There is another PPP program, so another help to small and mid-sized businesses in the United States. So again, this is a very positive news for the economy, which will probably bounce from this, and the expectation for the economy to grow is quite high and is getting higher and is getting even better. And as well, with these expectations, they are rising as well. Inflation expectation in US, you can see this affects again the yields from treasuries in the United States, as this is the main catalyst for the last week's sell-off. You can see after, let's look at some lower time frame, 5-day chart. You can see the performance of the yield on Friday was going sideways for most of the day. So the sell-off that we experienced on Tuesday, Wednesday, and Thursday was then on Friday retreated, thanks to the fact that those yields were stable for the most of the day. But as you can see right now on Friday, we are close to 1.6% on 10-year yields, which is fairly negative for stocks. And you can see we are again going to test the lower prices on technological index Nasdaq, but as well as technological index, other stock indices are as well under the pressure, as S&P 500 is going lower to again test the lower prices. But you can see those indexes are much more resilient due to the fact that they include much more cyclical and value stocks, as these rotation from technological stocks to value and cyclical stocks has even speed up last week. So you can see Dow Jones, for example, which includes much more, maybe most of them only, value and cyclical stocks, as they will benefit the most from reopening the economy, vaccination process, and so on and so on. So again, this is quite negative, and like I said before, these technological stocks like Apple, Facebook, Amazon, they are their performance is obviously undoubtable, but also you cannot forget the fact that they are extremely overvalued, they are very expensive, and there is right now some space to consolidate, to reevaluate the valuation, stable the prices, and maybe get some more support from the investors later on, as we will wait and see how the market will react to the sell-off that has begun just today. If it will continue, or we will be able maybe to see some bounce. This is a daily chart. As you can see, we have broken the 100-day moving average, which is an extremely strong support for the market. We are moving towards the 200-day moving average, which is also quite a support for the market, which is closely watched by investors on Wall Street. So I would suggest you to watch these levels very carefully, as they might be the levels that will be used from the investors to jump in back into the market. So you can see we have gone from the very top over $1,700. Right now we are around $1,500 lower, which might be, like I said, extremely interesting opportunity for some investors, as these companies as Apple, Facebook, Amazon, Google, they will most probably still find a way to make profits, and even with the reopening of the economy, they will probably have even more space to get some profits. But like I said, these valuations were extremely high, so this catalyst, which is at this moment the rising yields from U.S. treasuries, is the main reason for the stocks to go lower, and can even push those stocks a little bit lower. So it will be all about the pace of the rise of the yields. If we will keep on rising with the pace, the current pace, 1.6%, very fast to 1.7%, we can see further weakening of technological stocks. But as we will see some stabilization on the market, as we seen on Friday, but most probably we will need to see it on some longer time frame. So you will see maybe area like this. If this will be happening on the markets, will be very good, and you can most probably jump back into the technological stocks. Last thing I will say about the stock market is probably the VIX index, which is also closely watched and should be closely watched. You can see on Friday we were decreasing steadily to around 25 points, and right now on Monday we are rising again towards 27, 28 points. So the overall nervosity and overall cautiousness of the markets should be still in place, and there's really not just yet the signal to buy the dip and get back into the stocks. So that's about it. U.S. stock markets, like I said, it was the main movement factor for the market last week, and will probably be as well this week. As you can see, DAX is moving quite positively, especially compared to the U.S. stock markets. Like I said, it's something that was for the most part of 2020 the main factor that was holding back the gains on the European stocks, which was the lack of technological stocks in the index or in the other indices. And right now, this is something that is holding those sell-off and holding those the gains, so holding them at the higher levels. So you can see that the DAX is moving towards the record highs compared to the Nasdaq, which is around 1,500 points lower. So that's about it. That's about DAX and European stocks indices as well. You can see, especially where was the last week's session interesting was on Forex, was especially US dollar, because the overall sentiment, which was quite negative. There was a risk of sentiment on the market, which usually tends to create more demand for US dollar, as was especially the thing that was happening on the market last week. And you can see it here. Euro was under heavy pressure. It broke 120 Then 119, it tested on Friday, broke it on the Monday. We can see further weakening of euro, but especially on the euro, because the vaccination process and the progress in Eurozone and European countries is much worse than in US. So those are the two different sides, where US dollar has a much more and much faster, much better, basically, better expectation for the economic recovery, as the Eurozone and Europe is very bad from the vaccination process. So the economic recovery will probably be not as fast as in United States, and this is also something fundamentally which, with the sentiment that is right now risk off, creates demand for US dollar, is putting pressure on euro. So euro is weakening below 119. Long term, though, we should expect US dollar to create some gains, to give up the gains and weakening further. But like I said, it will most probably all depend on the sentiment on other risk assets, especially technological stocks in US and, for example, US dollar. So that's about it on Forex. Like I said, Euro USD, US dollar was putting pressure on other currencies as well as GBP. But you can see right here is a perfect example for the different sides from the vaccination process, which in the UK especially is extremely good, extremely fast. They are vaccinating probably the fastest behind Israel, and that's something that holds the gains for GBP against the US dollar when the US dollar is rising. So GBP was under pressure, but not as heavy pressure as euro, and this will probably stay here also for the next week. You can see here a very strong support area on 137.48, where the market was testing the levels multiple times. So this multiple high broke it. We are expecting another test maybe this week, or the level here 139.19, where another heavy resistance area where the market might stop. USD Canadian Dollar, there's not really much to be said here, as Canadian Dollar was moving towards higher prices, especially due to the fact what was happening on oil, but also was weakening US dollar, so was more or less stabilized for the week. We will see what we can expect from Canadian dollar next week, but I'm not really sure if anything interesting will happen here. We will have to wait and see how this thing will play out and how the market will react to some macroeconomic news. Japanese yen is under heavy pressure from US dollar. This is quite an interesting thing, which a lot of investors are very interested how this thing will play out, because Japanese yen was, for the most part of recent years, the safe haven currency when something bad was happening at the market, especially on the risk currencies. But you can see right now, Nasdaq and other stock indices are falling down, and Japanese yen is falling down as well, which is something that we are not used to. It might be due to the fact that monetary and fiscal stimulus was also extraordinary in Japan, and can put the pressure on Japanese yen, and the US dollar might be the one that is in favor of the investors compared to the Japanese yen. Commodities markets were especially interesting last week, as there was an OPEC meeting on, I believe it was on Thursday. Was extremely unexpected what happened, because most of the market investors and the market especially was expecting that the OPEC is going to pump more oil from the month of April, but it did not happen. And expectedly, OPEC and OPEC Plus with the allies like Russia and Kazakhstan, they come to the conclusion that these prices of oil are interesting, and they will favor them in favor of higher production. So they choose higher prices, which is something that no one in the market has expected. They kept the production cuts at the current levels, and they will keep them there for another month. So with the supply disruptions around the world right now, there's some tension with the Yemen and Saudi Arabia, which also puts some pressure on supply and further expectation, and puts oil to higher prices. So that is something that is right now the main catalyst for the market. And like I said, the production should be lower with the recovery for the economy, and the demand should be also something that keeps the prices of oil quite high. So we will see how the supply and the tension on the Middle East will affect the market. But like I said, right now we do not expect the oil to go any lower than $60 a barrel. It really shouldn't be the factor for this coming weeks. Last but not least, let's look at gold, which retreated. It's something again like Japanese yen. You know, you can see that gold is really not the asset that you should be focusing on then when there's some uncertainty at the markets or in the economy. Also, the inflation expectation are rising rapidly, and the gold keeps on falling down towards lower prices than $1,700. You can see some possible bounce from the level here, 1,700. It's 38. Let's look at the higher time frame, 38.2% from the Fibonacci from this bull run. So there is some chance that we can see some bounce here, but like I said before, we have a huge consolidation area around this part, and you can probably see market going sideways here for the most of the part. You know, right now it's under pressure, especially from US dollar, which keeps on rising, but we'll see how this will play out in the coming weeks. Quickly, let's look at the economic calendar, what we can expect from the markets and from the economies around the world. On Monday, we do not expect anything interesting. On Tuesday, though, we have employment data from Eurozone and some Usd report and short-term energy outlook from Energy International Agency. On Wednesday, some data from China, CPI data from US, BOC interest rate decision on Wednesday, so watch out for that. With the stocks exchange of oil in US. On Thursday, we have ECB meeting, so one of the most interesting days for the markets and for the Forex markets especially. And on Friday, we have manufacturing data from GDP data, from UK, and employment data from US and PPI data, from Canada, and PPI data from US. So really not that interesting week in terms of macroeconomic news, but like I said, especially watch out for the yields, especially from the 10-year treasury. Watch out for wicks, especially for this yield and inflation expectation, which should affect the market even in the coming days. So this will be it for today's video. If you guys have any questions, leave it down the comment section below the video, and I will see you next week.